During 2012, under a new planned initiative, HMRC will be investigating SMEs and self-employed people as part of a campaign to identify inadequate tax record keeping. The Business Records Checks aims to uncover unpaid tax and poor record keeping. Although businesses will want to avoid fines and HMRC scrutiny, there are other advantages to proper record keeping. Consistent documentation of business expenses and income also helps with end-of-year tax planning. Given the current economic climate, maximising income and minimising tax liabilities could in some cases mean the difference between solvency or business failure. So here's some key points to bear in mind for tax planning. Taking dividends can be more tax efficient than drawing a salary, but there are a number of traps that business owners need to be aware of, and remember that all shareholders may be entitled to dividends. If you are going to use dividend waivers, then you need the paperwork to be done correctly and on time. However, it's important to bear in mind that if you only take dividends, you may not have enough net relevant earnings in order to qualify for full pensions relief. If you're claiming research and development relief, you need to consider the impact that extracting money via dividends will have on your claim. Under the capital allowance system, businesses can write off plant and machinery at a rate of 20% a year. However, in some cases, a 10% rate may apply. Rates, however, are due to reduce to 18% or even 8% from April of this year. Another change taking place in April is a reduction in the annual investment allowance. This allowance is aimed at smaller businesses and allows a business to claim 100% of the cost of new equipment against taxable profits in the year of purchase. From April, however, the £100,000 a year allowance will be reduced to £25,000. The Short Life Asset (SLA) rules enable businesses to claim better allowances on assets they sell or scrap within a defined period. The rules changed in April 2011 and the terms have been redefined from 4 years to 8 years for tax purposes. So business owners should now consider putting items into the pool which might previously not have qualified, and those in the pool coming to the end of their life consider whether they would be better off being scrapped. Small businesses need to be aware that there is a new pay-as-you-earn penalty regime, which was introduced in April 2010, but which not all businesses seem to be aware of. Normally, the due date for pay-as-you-earn payments is the 19th of the month if paying by cheque and 22nd of the month if paying electronically. If a company pays late once in the tax year, then there is no penalty, but more than once and a penalty will apply. There is no allowance for how late it is, either it is paid on time or it is late, even if it is a day late. The only concession for small employers is to allow quarterly payments where the average monthly pay-as-you-earn payments are less than £1,500.